Okay, this lecture is going to show you how to prepare a statement of cash flows. We're going to use the indirect method to prepare our statement of cash flows. A statement of cash flows is going to describe and categorize your change in cash flows for a period. Our period is the year from 2012 to 2013. So we will be describing and categorizing our change in cash, which, as you can see on the balance sheet, is a negative $23,700. We're going to categorize that into three sections: the operating section, the investing, and the financing. All of these are operating activities, investing activities, and financing activities. Alright, what goes underneath operating activities when you prepare it by the indirect method is you're going to start with net income, and then you're going to reconcile your net income back to your cash inflows and outflows from operating activities. So to do that, what you do is you look at your net income, which of course has your sales and your expenses. But sometimes you may make a sale on account. So sometimes this might have a sale in it that you did not yet get the money for. So if you also analyze your current assets, like your accounts receivable, you can see that if accounts receivable went up, then your cash actually is lower because you didn't get the money yet from that sale. So therefore, you can always utilize this rule. If a current asset increase, so if you have an increase in a current asset, you will actually decrease your cash by that amount. And the opposite would be true. If you have a decrease in a current asset, you will actually increase your cash. And to give you an example of that one, if your accounts receivable goes down, then to reconcile this net income back to cash, you would need to increase your cash because you received some cash from some customers that happened in a previous period. So it would actually have a positive change on your cash. Alright, the other side of this is going to be your change in current liabilities. And this is going to work different than your current assets. If you have an increase in a current liability, you are going to also increase cash. If you have a decrease in a current liability, you will decrease your cash. And let me show you an example of why this will always work. Inside your net income, you have some expenses. And you may even have an expense that you accrued, which means that you haven't yet paid for it. So your expense reduced your net income, but if you haven't paid for it yet, then your accounts payable would have gone up, and this means that you would have held on to that cash, so your cash adjustment will need to go up because you have not yet paid for it. So an increase in a current liability, such as accounts payable, will increase cash, whereas if you pay for more than what you expensed in that period, then it would be a decrease. So you can always use these rules. Alright, the other two things that we need to do, we're going to add back non-cash expenses such as depreciation or amortization expense. And that's because depreciation, as you can see here, reduced your net income, but it doesn't represent a cash outlay, so we're going to actually add that back. And the other one is to remove gains and losses. And you can see a loss right here where we took it out, but that's not a cash outlay either, so we're going to add it back. If you had a gain, you would actually remove it by subtracting it back out. Alright, so then you're going to sum your net income with these changes, and that will be your net increase or decrease from operating activities. Let's look at investing. This is going to be the cash paid or received for long-term assets. Okay, so your long-term assets are like your equipment, your investments, your land, your automobiles, anything that's a long-term asset. If you're holding stock in another person's company, that would be a long-term asset for you. We'll talk about when it's your own stock. That's different because that's actually going to be down there in stockholders' equity. Alright, so your cash paid or received for long-term assets will go under investing, and then under financing, it's going to be cash paid or received for long-term liabilities. Okay, this could be notes payable, bonds payable, and anything that happens in the stockholders' equity section. Okay, so we generally see issuance of common stock. You may have some treasury stock transactions. You may have some payment of dividends. That would be what you would see under the stockholders' equity transactions. Alright, so those are the way that we're going to categorize this change. So let's get started. Under operating, the first thing we're going to do is add net income. So I get my net income right here from my income statement. It's $114,975. And then next I'm going to look for my change in my current assets other than cash. So I start with my accounts receivable, and I'm going to describe that by saying it was an increase in accounts receivable. And so since it was an increase in a current asset, I decrease it. So I'm going to say minus 15,185. And then the next one is my merchandise inventory, and it was an increase in merchandise inventory. And so I'm going to decrease it, 23,856 from right here. And then my next one is my prepaid expense, because you're going to assume that prepaid expenses are current unless you're told otherwise. So in other words, if that was prepaid insurance, I'm using it up in less than a year, so it's current. So my decrease in prepaid expense, because it went down throughout the year, will be added back as 625. The next asset that I see is equipment. That's long term, so I won't include it under operating. So I go to liabilities. Accounts payable was a decrease, so I say decrease in accounts payable. And because liabilities work the same, in other words, if they decrease, I decrease, I'll say 61,000 is a negative. Short-term salaries payable is going to be a plus $4,000. So I'll say an increase in salaries payable is going to be a plus $4,000. I stop there because after that come my long-term liabilities, and they don't go under the operating section. So next what I do, I've done my net income, I've done my change in current assets, I've done my change in current liabilities. Next I'll add back depreciation and remove gains and losses. So I'm going to say add back depreciation expense, and I just want this period's depreciation expense because that's all that came out of my net income is this period. So I want to say plus 20,750. I need to remove the gains or losses that were, in this case, subtracted as a loss out of this period, so I'm going to add back 5125. Alright, and then when I sum up from net income all the way down, I get that my net cash provided by operating activities is $44,900. Next, we're going to work on the investing section. And so in this section, we'll be looking for anything that happened to our long-term assets. And the only items that we're going to write down are what happened to our cash. Either it went up or down for these items. So if I look here, I can see that my equipment went up by $49,500, but my accumulated depreciation changed by something other than just this period's depreciation, so I probably bought and sold some equipment. So if I look down here, I can see that I sold equipment costing $46,875, and it gives me some additional information. But in looking through letter A, it doesn't tell me how much cash I got when I sold this equipment, so I'm going to put it into a journal entry. I'm going to recreate that journal entry and find out how much cash I would have gotten. So I know I got cash when I made this sale, and I know that I have to get rid of some accumulated depreciation when I sell this, and I also have to, it says recognize a loss, and I also have to show that I don't have that equipment anymore, so I have to get that off my books. Alright, so I'm going to get the equipment off the books at the cost. They told me it was $46,875, so I'm going to credit that off my books. They told me that I recognize a loss of $51.25. A loss has a debit balance because it works like an expense. So I'm going to recognize the loss with a debit. Accumulated depreciation, I need to get rid of that balance because once I sell that, I don't need to have that on my books anymore. So now I'm able to solve by making my debits and my credits equal to find out how much cash I must have gotten in this sale. It would have been $11,625, and I did that just by making my debits equal my credits. So here, let's recap this journal entry. I sold some equipment that cost $46,875 at a loss. I got $11,625 for it in cash. An easier way, or for some people love journal entries, some people like looking at it a different way. Let me show you a different way to look at this. You could say that you had equipment worth $46,875, that you had depreciated it over the period of time by $30,125, so that it now has a book value of $16,750. Alright, so if that's the case, if you had no gain or loss, you would have sold it for $16,750, but you weren't able to sell it for that much, so instead you only sold it for $11,625, and so that left you with a loss of $51.25. So that's why this journal entry works this way, and sometimes it's easier to see it in this narrative approach. But either way, all you have to do is make sure that you can solve for cash, because that's the amount that you'll record on your cash flow statement. So what I'll say is cash received from sale of equipment. And again, we only care about the cash amount, so it's going to be, I got $11,625, so it'll be a positive. Now let's look at the second one. Purchased equipment costing $96,375 by paying $30,000 and signing a long-term notes payable. I don't have to solve for anything because I'm going to look for my cash. My cash was that I paid $30,000, so that's the number that will go right here. So I will say cash paid for purchase of equipment, and it'll be $30,000. Alright, at this point I can say that I have net cash used in investing activities, or by investing activities. I say used because I used more than I brought in, so I'm going to say used in this one. Let's look under financing next. Alright, that'll be your long-term liabilities and your stockholders' equity section. So we're looking at these items right here. My long-term notes payable changed by $16,250, but it doesn't say how much I got or paid, so I'm going to need to do a T account of notes payable and find out what went on. In notes payable, I started off with $48,750, and then in letter B I added to that because I financed part of that equipment. So I added the difference in the amount that I bought that equipment for and my down payment on it. So that was $96,375 minus $30,000. So I must have financed $66,375. I know from my balance sheet that my ending notes payable balance needs to be $65,000. So I can see that I needed to have some sort of a debit over here, and that must be because I paid down some notes. So to get from $48,750 plus $66,375 to that $65,000 balance, I can solve and find out that I must have paid down my note by $50,125, and that's just an assumption that I can make based on the numbers that I'm given. So I would say that payment on note payable, cash payment on note payable would be I spent $50,125. Alright, and then next I'm going to look at my common stock. Basically, common stock journal entries look like this. I would say, that you have cash, and then you write down common stock and you put that one at par value, and then everything above par goes to paid in capital and excess of par. So looking at this, if common stock went up by $12,500 and the paid in capital went up by $37,500, then that must mean that this journal entry happened. 12,500 and $37,500. So I must have credited my common stock for $12,500 and my paid in capital for $37,500, which must have meant that I got a total of $50,000 for issuing that stock. So I'm going to write cash received from sale of stock or issuance of stock. Both are correct. And that made it go up. Alright, and then the last account that we're looking at is retained earnings. So part of retained earnings went up by net income. We don't need to do anything with that because we already took care of net income under our operating, but we need to see, did it change for anything else? We have beginning retained earnings, and then we'll say that we always add net income to that, and then if we declared any dividends and paid them, we would subtract dividends, and that would give us to our ending retained earnings. You probably recognize that as your statement of retained earnings. So if we just flip that round just a little bit, we can say beginning retained earnings add net income less ending retained earnings, and that will allow us to solve for any dividends that we paid. Alright, so my beginning retained earnings from my balance sheet is going to be $120,125. My net income from my income statement is going to be $114,975. My ending retained earnings is $185,000. So when I add that and subtract out ending, I find out that my dividends were $50,100. Cash paid for dividends is $50,000. I paid it, so I minus it. Alright, so then I can find out that my cash used for financing activities is $50,225. To get my net cash decrease, I'm going to add up what I got from my operating, investing, and financing. Then what I'm going to do to make sure that I'm right is I'm going to go in there. First of all, I can look up here and see that my change was $23,700, and since I calculated $23,700, I know I'm right. But to finish out this cash flow statement, I have to prove it on the cash flow statement. I do that by saying beginning cash. So I'll look at my balance sheet and get my beginning cash, which was $73,500. And then I'm going to say $23,700 netted with $73,500 better give me my ending cash number. And if it does, when I net these two together, then I know that my cash flow statement is in balance. So does $49,800 equal $49,800? It does, so I'm finished. And then the way that I'll read this is I'll say, hey, of my $23,700 net decrease in cash, $44,900 of an increase came from operating, and the rest was cash uses from investing and financing. So this looks like a healthy company because we have positive cash inflows from operations.